You need to understand the true depth of your knowledge. In this video, you get 10 questions that will challenge your financial IQ. Don't worry though, whether you're a pro or a beginner, you'll walk away with insights that will make you better in business. Let's get started. Question 1. What is compound interest? Now, this is a term that you've probably come across if you've dipped your toes into the world of savings or investments. But do you know what it means? Compound interest is not just a fancy financial term. It's a secret sauce to wealth creation. Imagine you invest $10,000 at an annual interest rate of 5%. After a year, you earn $500 in interest. Simple enough, right? But here's where compound interest comes into play. Instead of taking that $50 out, you leave it in the account. Now, in the second year, you earn interest on $10,500 instead of the original $10,000. As time goes on, your interest makes more interest. Think of it like a small snowball rolling down a hill. At first, it's small, but it keeps getting bigger and bigger. Your money grows in the same way. The longer you let it grow, the more money you'll have. Understanding this idea called compound interest is really important for saving and investing. It helps you make more money without doing anything extra. Whether you're saving for a home, retirement, or just a rainy day, compound interest can help you reach your goals faster. It's a foundational concept in personal finance. So, if you got this one right, give yourself a pat on the back. You're on the right track, and you've just unlocked one of the most powerful tools in building wealth. All right, on to question 2. What's the difference between a credit card and a debit card? This might seem like a basic question, but you'd be surprised at how many get tripped up by it. Let's break it down. A credit card is like a small loan. When you buy something, you're borrowing money up to a certain limit, but you have to pay that money back, and sometimes with extra cost if you don't pay it all back in time. It can be good because it helps you build a good credit record and could give you benefits like cash back. But if you're not careful, you are likely to end up owing a lot of money. A debit card is different. It takes money right out of your bank account when you buy something. You can't spend more money than you have in your account, or you might get extra charges. Why is this important? These cards look the same, but they work differently. Using a credit card wisely can help you in your money plans, but a debit card makes sure you only spend what you have. So, do you like to borrow with credit or spend only what you have with debit? Share your thoughts in the comments. We've come to our third question. Are you ready? What is dollar cost averaging? This one's a bit more nuanced, and it's a favorite among many seasoned investors. Dollar cost averaging, DCA, is a strategic approach where you invest a consistent amount of money at irregular intervals, say monthly or quarterly, into a particular asset, like stocks or a mutual fund. Now here's where it gets interesting. You do this regardless of the asset's price at the time. Why is this smart? Well, when prices are high, your fixed investment buys fewer shares. And when prices are low, it buys more. This can even out the highs and lows of market volatility. Think of it like a self-regulating system that doesn't let market fluctuations dictate your investment strategy. What makes DCA particularly appealing is its psychological benefit. Investing can be emotional, especially when the market is unpredictable. By adhering to a fixed schedule, you can take some of the stress and guesswork out of deciding when to invest. You're not trying to time the market. Instead, you're committing to a disciplined, methodical approach. Some critics might argue that DCA doesn't always maximize returns compared to a well-timed investment. But let's face it, predicting the right time to invest is more luck than science for most of us. So how did you do with this question? If you're already practicing dollar cost averaging, kudos to you for embracing a method that can reduce risk and promote steady growth. If this is new to you, it might be a concept worth exploring further, especially if you're looking for a long-term investment strategy. Next in line, question 4. What is an emergency fund and why is it important? So, financiers, let's break this down because an emergency fund isn't just a nice to have, it's a necessity. An emergency fund is a stash of money that's readily accessible, like a savings account, specifically earmarked for unforeseen expenses. This money isn't for fun things like a quick vacation. It's for serious problems like fixing your car, paying for medical bills, or if you suddenly lose your job. Why does this matter so much? Let's say your car stops working. If you don't have an emergency fund, you might have to use credit cards or take out a loan to fix it. That means you could end up owing more money and feeling stressed about it. An emergency fund is like a safety net that keeps you from these problems, but it's not just about the money. Having this fund can also make you feel safer and more sure about your money choices. Knowing that there's something saved up for your unexpected problems can make you worry less. It's like having a financial safety net that allows you to walk the tightrope of life with more assurance. So, how big should this fund be? Experts often recommend having enough to cover 3 to 6 months' worth of essential living expenses. Building an emergency fund doesn't happen overnight, but even starting small can make a big difference. Regular contributions, even if small, can grow your fund over time. Did you get this question right? If so, great job. If you don't have an emergency fund yet, make it a priority. Life is unpredictable, but your finances don't have to be. Your future self will thank you. And if you share this video with your friend, he will thank you too. Now let's tackle question 5. What's the difference between good debt and bad debt? This question might sound tricky, but it's at the heart of financial management. What makes debt good? Good debt is like an investment in your future. It's money borrowed to finance something that has the potential to increase in value or generate long-term income. Consider the example of taking out a loan to invest in a property that you expect to increase in value, or starting a vending machine business that has the potential for consistent revenue. These kinds of debts can be seen as good because they are investments that might help you earn more money in the future. Good debt usually comes with lower interest rates, and there might even be tax benefits. On the other side, there's bad debt. This often happens when you borrow money for things that won't help you financially in the long run. Examples might include using high-interest credit cards to buy the latest electronic gadgets, or fashionable clothes that quickly go out of style. These items lose their value over time, and the debt remains, possibly becoming a financial burden. These items depreciate quickly, and if you're paying interest on them, they can become even more costly over time. Managing debt wisely means recognizing the difference between these two and making conscious decisions about borrowing. It means asking yourself if the debt will provide something lasting and valuable, or if it will just satisfy a short-term want. If this concept is new to you, it's worth taking the time to evaluate your current debts and see where you might be able to make improvements. Remember, financiers, not all debt is bad, but understanding the difference between good and bad debt can make a substantial difference in your financial well-being. Let's delve into question 6. What are the key components of a personal balance sheet? If you're serious about understanding your financial situation, this is a tool you'll want to familiarize yourself with. A personal balance sheet is like a financial mirror, reflecting your monetary health at a specific point in time. It's composed of 3 vital elements. Assets, these are what you own. This can include anything from your home and vehicles to your savings, investments, and personal property. Basically, if it has value and belongs to you, it's an asset. Liabilities, these are what you owe. From mortgages to credit card balances, student loans, and other forms of debt, liabilities reflect the obligations that you need to fulfill. And net worth, this is the difference between your assets and liabilities. By subtracting what you owe from what you own, you can determine your net worth, which is a clear indicator of your financial standing. A personal balance sheet helps you see where you're strong financially and where you might be vulnerable. It can reveal opportunities to invest, areas where you might want to reduce debt, and guide you towards achieving financial excellence. Creating and regularly updating a personal balance sheet could be one of the most insightful financial exercises you undertake. It's not just for business. It's a powerful tool that anyone can use to gain clarity about their financial situation. We've actually done another video which goes more in depth into strategies just like this one. The video is exclusive for members of our Wealth Revolution course, which drops pretty soon. So subscribe to our channel so you don't miss out on the launch. Let's continue with our 7th question. What's the difference between a fixed rate and a variable rate loan? This might seem like banking jargon, but it's actually a vital concept when considering borrowing money for a home, car, or any significant purchase. As the name implies, a fixed rate loan has an interest rate that stays the same throughout the life of the loan. No matter what happens in the market, your interest rate and consequently your monthly payment will remain constant. This offers stability and can be a good option if you plan on holding the loan for a long time, especially when interest rates are low. Conversely, a variable rate loan has an interest rate that may fluctuate over time, typically in alignment with prevailing economic conditions. This means your monthly payments can go up or down. While this might sound risky, variable rate loans often start with lower interest rates compared to fixed rate loans, potentially saving you money initially. However, if interest rates rise significantly, so will your payments. So why does this matter? Choosing between a fixed or variable rate loan is a significant decision. A fixed rate loan offers predictability and peace of mind, knowing that your payments won't change. A variable rate loan, on the other hand, might save you money if interest rates stay the same or decline, but it carries the risk of rising payments if interest rates go up. Understanding these two types of loans allows you to make an informed decision based on your financial situation, risk tolerance, and market conditions. It's not just a matter of preference. It's a strategic choice that can have long-term financial implications. If you're considering a loan in the future, this knowledge can guide you towards the options that align best with your goals. So how did you do with this question? Understanding loans is an integral part of financial literacy, and knowing the difference between these two types can make a significant difference in your financial journey. Now, here we are at question 8. What is a mutual fund? If you're looking to invest but aren't sure where to start, mutual funds might be the answer for you. Let's break down what they are and why they could be a smart choice. A mutual fund is an investment vehicle that pools money from various investors to buy a diversified portfolio of securities such as stocks, bonds, real estate, and other assets. It's like a basket filled with different investments, and mutual funds are managed by investment professionals who make the buy and sell decisions based on extensive research and analysis. They're there to navigate the complex world of investing for you. By investing in a mutual fund, your money is spread across many different securities. This diversification can reduce the risk compared to putting all your money into a single stock or bond. With mutual funds, you don't need to be a millionaire to start investing. Many mutual funds have low minimum investment requirements, making them accessible to the average investor. There are many types of mutual funds, each with different investment objectives and risk profiles. Whether you're looking for income, growth, or preservation of capital, there's likely a mutual fund that aligns with your goals. So, financiers, the more you know about investing, the more empowered you'll be to make informed decisions. Next, question 9. What is the rule of 72 in investing? This might sound like some secret formula, but it's actually a straightforward and incredibly useful tool in the world of finance. Here's what it's all about. The Rule of 72 is a mathematical trick used to estimate the number of years required to double an investment at a fixed annual rate of return. So simply divide the number 72 by the annual rate of return. The result is approximately the number of years it'll take the investment to double. For example, if your rate of return is 6%, dividing 72 by 6 gives you 12 years. The Rule 72 is great for making quick mental calculations without the need for a calculator. It provides a ballpark estimate that can help in planning and comparing different investment options. By quickly assessing how different rates of return affect your money, you're going to make choices that align with your financial goals. Keep this rule in mind and you'll find yourself using it more often than you might think. And finally, question 10. How do taxes impact your investment returns? This isn't just a question for tax season, it's something to consider all year around. Here's what you need to know, the basics. Taxes can take a significant bite out of your investment returns. Different types of investments are taxed at various rates depending on factors like the type of investment, the length of time it's held, and your tax bracket. If you sell an investment for more than you paid, you might have to pay capital gains tax on the profit. The rate can depend on how long you've held the investment. Some investments, like stocks, might pay you dividends. These can also be subject to taxation. By understanding how taxes work, you can make smarter investment decisions. For example, you might choose investments with lower taxable distributions or invest in tax-advantaged accounts. Tax laws can be complex. Working with a financial professional can help you navigate the tax landscape and make decisions that align with your overall financial strategy. The bottom line is, understanding how taxes impact your investment returns can make a real difference in your net returns. It can help you keep more of what you earn and align your investments with your financial goals. Remember, financiers, your financial IQ isn't just about knowing the answers. It's about applying this knowledge to make more informed financial decisions. Now, speaking of wealth, before we wrap up, I want you to understand what an exciting event is coming up in a few weeks. The Wealth Revolution. Whether you're a seasoned investor or just starting, this is a golden opportunity to learn from new investment strategies and take control of your financial future. We'll dive deep into topics like investment planning, tax strategies, wealth management, and much more. Don't miss out on the Wealth Revolution. It's your chance to take your financial knowledge to the next level. Follow our channel so you don't miss out and stay tuned for more details. Until next time, invest wisely and stay financially savvy.